Alrighty, let's talk long-term investing. I hope you guys are having a good weekend. I want to go over this in two senses. I'm going to share some stocks with you guys that I like for long-term investing, but more, I'm going to be sharing with you just how to go about looking at something fundamentally and making a good long-term decision. And now, excuse me, why I'm saying that is given really just where the market is right now. We go look at the S&P 500. This is a interesting point to be getting into a long position. One, it's cheaper than most spots in the last 52 weeks, but you pull up a 2, 3, 4, 5 year chart. I it, it's you're still paying a good price. So we're going to talk about scaling in. I have in my videos. If you guys don't know my long-term portfolio, I've been literally, I started trading here. This is when I first started getting some of my first long-term stuff. And it was a similar time where stuff I bought here and held for, 10 years later till 2018, it ended up great. And that's kind of, you could say we're at a similar inflection point at the market, but a lot of the good pickups came around here and right here and, letting that come. So I want to talk about some of the factors we want to look for. This is going to be scaling in. And then, a lot of people have requested this video. I have a huge long-term portfolio. It's well above 8 figures. It's spread out a lot of stuff. It's individual portfolio. Then I have the people I work for, the people I work with, all that stuff. So it's, long-term investing is great. I don't underestimate it. In the free stock trading course, I discuss, if you guys want the cheat code to the stock market, invest long term, stick your money there, walk away, do not trade, do not trade, do not trade, and you're going to make a lot of money. The market is rigged if you play by the rules, and that's one of the rules, is finding the good companies to invest in. And that's what I'm going to talk about here, is what are those companies? How do you identify those? And we're going to specifically talk about PE ratio, price to earnings, and understanding that. And I'm going to share with you a few of the companies I'm looking at right now that I want to add more of if they start to kind of, if the market does do that. But I'm starting to see a window open for that. So I will get into there. And before I get into any intro with even what I have to say, let me say this too. The long-term portfolio, the ones you guys who've been asking me for this video, if you have less than $20,000, $50,000, even $100,000, it's going to be a different type of, going long. I still recommend you do it, and I think you should do it. So, but just understand there's going to be a difference of, when I'm thinking long, it's like, allocating a large amount of money to sit there. Now, I will say, eliminate this fallacy that you need a lot of money to make money long-term investing, because 50%, 20% of any amount is 20%. Obviously, it's more worth your while if you have a bigger amount, because long-term investing takes a long time to see, the exponential gains you would have got if you bought certain things. But I was on the phone with some people. Some people have shot me emails. And I said, don't forget, I did this. I did my $600 in Amazon into $30,000, and that was around 2015. And that $30,000 of Amazon, what that turned into is, it's now 30,000 bucks turns into $300,000, not just in a 3-4 year period. So a lot has happened there on the investing side, and we're going to talk about that. And Amazon falls into this category of PE and price to earnings ratio. So let's begin. And this is going to be probably one of your guys' really big first fundamental lessons. A lot of you might know this. You should know this. If you have been trading, something like, Josh, PE ratio, this is basic. Well, let's get it out of the way for the beginners. Let's explain it for them. But a lot of you long-term investing now, I want to ask you, are you using price to earnings correctly? There is a few opportunities being set here, and there is ways you could traditionally look at price to earnings ratio, but there's a lot of things people look and view price to earnings with that is just flat out wrong. So if you don't know, price to earnings or PE ratio is literally price to earnings. So it's a ratio. When you do a ratio, you divide it. So we're going to pull up our calculator, right? If you get a ratio, you guys ever see like model cars? I'm a model car. I'm really into cars. So if there's a model that's like 1/2 or 1/16, a ratio, it's saying one model is, one real one is about 16 of these ones, or one real one is like 2 of these ones, or so on and so forth. It's a ratio. It's division. So what you're having here with price to earnings is when you take a company, take the price of the stock. So in this case, it's Amazon, right? 1670. Price is $1,670. So price, and now ratio, just like a ratio would be, a ratio you would see, you guys are common seeing like, this is the ratio, right? 1-to-1, or this is a ratio, even in 1/2, that's 0.5 is still a ratio, right? So let's pull that up here. So it's 1670 divided by, what's our EPS? Our earnings per share is, that's NVIDIA. Can't get confused. See, it'll give us a different number. 1785, and this is the yearly EPS. So when this is a big feature of mine I like on E-Trade, this is called the quick quote. It's telling me the earnings per share on the year, and it even tells us the PE ratio. We already have this 93. We see Amazon's PE ratio is 93. So we're going to talk about how to interpret this, right? But simply, you take that PE ratio, 1670, divide that by $17.85 is what they earn on the year. You're going to get 93.56, boom, that's the number we rounded up to. So it's pretty much saying price is 93 times earnings. That's it, 93.5 times, because that's what it is. It's a ratio. You literally just divided price by earnings. So then all this is telling you is that you're paying this many times over for the earnings. You're paying $1,670 of share to get only about $17 of earnings per share that year. So this is where they call the multiple. You guys have probably heard this. People say, oh, what's the multiple on the stock? Or it's trading at a 15 times multiple. Amazon, in this case, is trading at a 93 multiple. It's trading 93 times its earnings. So it's trading at a price literally 93 times higher than earnings. So now let's get to the bread and butter of price to earnings ratio. Why do they do this? What does this have anything to do with? Well, one, maybe we're not going to dive too deep on the investment scale, but this is where you guys, let's go to pricing. We're going to skip, this is now fundamental, but also business wise and understanding now business in general, because we're going to skip this. Okay, why do they care about this? What does it tell you? Price to earnings. If you're paying many times over the earnings, or we could grossly simplify this to say intrinsic value if we wanted to, you got to ask, the more you're paying over something, the worse. So think about your premium, and that's what they call this. They call it earnings. They say, what's the premium on the stock? You're trading at a 93% times premium. It's the same thing of options. Now, remember, we're talking just stocks here. We're not talking options, so separate the terms premium, but it's saying you're paying 93 times over what the company earns. So this is how PE ratio works. The higher the price to earnings ratio, then the lower, I should probably Google Docs. I'm gonna write this down for you guys. Come on. Okay. The higher the PE ratio equals, the more expensive the stock. The cheaper the PE ratio equals, or the lower the P ratio, the cheaper, more appropriately valued the stock. So this is just the simple definitions, right? This is how you look at it. Now, that's why people say if it has a high price to earnings, it's expensive. If it has a low one, it's not as expensive. But now you have to ask yourself, why is it getting higher or lower? Think about it. The company reports how much it's making. We know how much the company earnings does not change. The only thing that what changes with PE ratio is what the market's willing to pay for it. Because as the price of the stock goes higher or lower, that changes the PE ratio. So if Amazon earns the same amount of earnings and their earnings revenue doesn't increase, but the price goes up, that means people are willing to pay more money for the same performance on Amazon stock, and vice versa. If the stock dropped in price, but Amazon kept making the same amount of money, people are like, well, no, we're going to pay less for the same amount of earnings. So that is both of those scenarios. Do they think it's going to, why are they willing to pay a premium? Why are they willing to pay more for the same earnings? Or why would they be willing to pay less for the same earnings? It's telling you how the stock views growth. And we're going to talk about that. But now, the next thing is, we live in a day and age with like a PE ratio of 93 on Amazon. Let's see what's Facebook's is. But we'll actually have to, my link isn't working on it. I don't know why. What's Facebook at? 22. What's Google's at? Google? Whoa. What do you mean Google? hold on. 40. We saw Nvidia 33. You're gonna see stuff. It's just like, why are people paying such ridiculous amounts for stuff? What's booking at BKNG? That's 30 times. It's saying like, and think about that. Amazon $1,700, bookings $1,800. You're paying 90 times earnings for Amazon, and you're paying 30 times earnings EPS here for booking. But again, now it's like, can you compare those? Well, which one's more expensive? Theoretically, Amazon's a lot more expensive, even though booking has a higher price, because you're paying more for less earnings and you're paying a similar price per share. However, now the key is the industry. Booking is travel and company. Amazon is retail and tech and cloud and all sorts of stuff, right? So putting this into context, how you compare your price to earnings is you have to now look at it by the industry. So if there is, that's the next thing you want to do, pretty much how to tell if PE is high or low or normal or not. I don't know if that's the best way to do it. Compare to industry. So I have it pulled up here. You guys could even just Google this. Average sector PE ratio. Go look, and that's the thing. One, this is telling us the sectors, the current PE, and then we could compare it to this. So that way you're able to say, okay, let's say if Amazon was advertising and we're seeing that the current PE out of 48 companies is 35 and it's trading at 93, that means Amazon's more expensive. So I'd be cautious of Amazon in that sense, but does that mean trade it and don't trade it? That's what I'm going to wrap this up with to understand. So you could either do this, find the actual industry PEs and compare them, but understand there's a lot of noise here. 48 firms, 85. These companies might not all be similar. What I like to do is just go through, find the companies that I know are competitors or related to it, and look at them. So like Booking, you would look at like Expedia. Booking's at 30. Expedia's at 40. Let's see. It looks like Marriott's at 23. TripAdvisor's at 357. So even right, I'm saying TripAdvisor is the most expensive. We should probably short them. And you see, this is going to give us idea. You could use PE ratio as these could be one indicator. You see, I'm like, okay, that could be a good idea to short it, but we'll get back into it because at the end of the day now, does this give you an indicator to buy or sell something? Does PE ratio tell you if stuff is cheap or overvalued? Yes, it does. It's one area to look at, but it's just like technicals. I'm not going to use just one indicator to make my judgment off of it, but it does give us a really good insight. And now you guys are like, okay, well, what are you buying for your long term? What am I looking for? I'm doing two things now with price to earnings. So now that I give you guys the quick summary on it, what do I want out of my price? I want companies that have had high PE ratios that have recently came down. So meaning the best example is Facebook. I want to buy more Facebook because now Facebook is cheaper. Literally, Facebook is cheaper than when I bought it almost a decade ago. It's just kind of crazy to think about. When I bought Facebook around these prices, the big difference was I paid more dollars than what Facebook was actually earning. So in this case, Facebook's been earning a lot more, but now take a look. The price, think about what they were making more and more money every year. That's what shot the price up. And as they were making more and more money, people kept expecting more and more things to happen. Think about it. They bought, did Facebook buy LinkedIn? Was it them? I think they bought them. Think about all this stuff they own. But now in the last year since this Cambridge, this bad earnings, it was that one bad earnings, they had this haircut. They're still earning a lot of money, but now the price has dropped. So earnings stayed somewhat the same. Earnings is still increasing. It's only 60. Oh, that's TripAdvisor. It's like, wait, what? Yeah, Facebook, $6. Earnings is still going up, or at least still holding, but stock has dropped a lot in value. So think about price to earnings now. That PE ratio is lower. At one point, the PE ratio on this was about 100, I believe, back in 2014, 2015. I remember that. So you're getting it at a very, very cheap thing. So now this could be, it's indicating the negative side, and this is where you have to understand. With PE ratio dropping, people are expecting less growth. This is my worry. I am very bearish on Facebook in the short term, but I'm bullish on it in the long term. So hopefully I expect some short-term headwinds because people are clearly worried about growth perspectives here with Facebook. However, if looking at it from a long-term perspective, looking at it historically, the price, the premium of what we're paying and how much it has grown in the past, obviously the future growth is the worry. It's cheaper than what it is. This is what I want, and this is the type I'm going for. So Facebook's one thing I'm looking for. Do you want to aim for low PE stocks? No, this is a misconception. I want stocks that had high PEs that dropped. Amazon is one of those. Amazon dropped too, but I don't want a low PE stock. I don't want a low energy, earnings like energy. I don't want any of those. I don't have any long-term energy ones unless those ones are going to be a different type of play. That's not a PE value play. I do have long-term oil and energy companies. I'll make another video with that, but that's based on book value. That's going to be based on like pure fundamentals. So here, I'm trying to avoid a few things with it. I don't want too low of a PE ratio because the cheap PE ratios or the lower earnings, the lower price stocks, those companies could just be companies with just shit growth. They're not going to grow at all, and they have a low PE for a reason. That's the next thing you got to realize. When the market is displaying a low PE or a high PE, if you only aim for low PEs, you can miss out on a lot of winners, and vice versa. If you only aim for high PEs, the growth is already baked in there. So you got to find the balance. I guess that's what makes the markets beautiful and timely and interesting, but just keep that in mind. So that's those plays. The last one, Procter & Gamble. This is a big one I'm holding long term that I have some. I want to get more, but again, it's at this high price, so I'm waiting. And again, the price to earnings ratio is high, and this is where you have to see. This is where Procter & Gamble becomes a winner, because I know their EPS hasn't been growing that much, but it stayed solid. But now as people started getting worried, right? Even look in October, it dropped a little bit. These are the times you want to get it, but since then, the price is going back up now. So if it holds that price, earnings keeps growing, we're paying a premium. But man, I don't really like that. Let's take Johnson & Johnson. Oh wait, that's Amazon. What am I? I'm retarded. It's like no way. 22. Thank God. But yeah, it's still pretty high. Let's see now. I want to compare it now to Johnson & Johnson. Whoa! What? No way. Am I tripping here? So we gotta look into that. That's crazy. Price to earnings is 217. That doesn't seem right. So PG again is seemingly the deal. What else is there? Let's see, like Clorox, surprisingly. PE of 23. These are staples. Like literally, let's even like McDonald's is nothing like P&G. But again, I'm looking at these more staple stocks, the stocks that go up and still earn a lot of money. And again, these are the prices going up. Earnings is staying steady while the market's going down. And that is the question. That is where we're trying to find safe havens, good stocks, whatever it may be. So, yeah, I'll leave it at that. Hopefully you guys learned something. Hopefully you have an idea. Let me know what you guys think. And if depending on the size of your portfolio, you could send me an email, comment below. Check out the free stock trading course. I explain a decent amount in this. And we're going to talk next I didn't say this in the beginning. I should have selling premium because if you're doing long-term, even short-term now, big accounts, small accounts, I think a lot of you guys need to start getting on that train as with how this market is kind of progressing and what it's showing us. So we'll talk about that. Let me know your guys' comments, questions, all that stuff. Show me love. I love you guys. I hope you have a good weekend. We're going to be streaming tomorrow, so get ready. Yeah, bye.